There's a few things. I mean, the biggest thing for the year, full stop, is the front end of the yield curve moving up. And so we're watching the Fed to see, when are they going to, our view is you're going to keep moving this year, but next year is going to be questionable in terms of how much they're going to get to go. Front end of the yield curve is a big deal. The second other big deal that I think people underestimate is when Draghi said, we are going to keep rates where they are. We're not going to move rates higher till at least the summer of next year. For interest rate markets around the world, you just put a cap on developed market interest rates. I mean, bonds are trading at 34 basis points. It's hard for our treasuries to move dramatically higher. We'll talk about why they will move higher.
I was going to approach that issue a different way in that I just think he was echoing the current situation of growth over there. Yeah, that was a reflection that things aren't what I don't know how many times I heard synchronous global growth. Yeah. Then Italy came along and Germany's not doing that well either. And I don't know whether it's good or bad that it tethers us. I think we need to go higher, but it's going to tether us lower. I like that for the stock market, but does it put us behind the curve?
100%. I mean, the Fed, it was interesting when you heard at the Sintra conference, when Powell said, he made the comment about, normally the Fed says, we're setting monetary policy for the United States. Well, all of a sudden, he changed a little bit and talked about global growth and talked about the U.S. sensitivity to global growth. You weren't there, were you? I was not there. I was here.
I've been. It's important. It's a beautiful. I can't believe I've been there. But Sintra is a beautiful, beautiful place. The nicest in.
Yeah, no, but we have to be sensitive to global growth. I mean, the data in Europe, like you said, has fallen off a cliff. I think it's you had some what was above trend growth that now is decelerating back to what should be trend, but trend's only 1.5%.
We're going to hear it blamed on trade, and that we're doing something to Europe with tariffs. There's no evidence that it wasn't something domestic that caused this. Is there? Or?
I agree. I mean, the only thing you have to think about, that it's really hard cutting through the data. If you're running a big multinational and you're thinking about inventory build, or you're thinking about what you can do on CapEx, it doesn't hurt to just say, let me take a couple of months, let me take a few months. So why would data fall off so quickly? Maybe you pause. But there's no doubt U.S. growth is different than the rest of the world and will continue to be so.
Well, we don't need a flat yield curve then. I don't get that either.
We don't need
it. So the rest of the world's giving us a flat yield curve or something?
So there's a couple of things. First of all, the pension fund demand for the long end of the curve is extraordinary as the pension funds have closed their funding deficits. The bid for the back end that comes from pensions, that'll be there. It'll go away somewhat after September, but that'll be there. The other dynamic,
every time we see yields pick up,
right, the back end is incredible. But there's something really important. When yields move higher, the long end tends to lag. But if growth slows in the U.S. or the Fed stops, then the curve is going to start to steepen out. So one of the things that when you think about the yield curve is if it's what we call bear flattening, meaning that you're going to have a dynamic where interest rates move higher, that's when the long end is going to lag, but it'll go the exact opposite way in the dynamic where the Fed stops or growth slows.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.